It's been 100 days since the Strait of Hormuz was closed. 20 million barrels per day have been trapped in the Persian Gulf, of which barely 5 million are managing to escape. This is the largest downturn in the sector's history. The supply disruption is 3 to 4 times greater than during the infamous oil crisis of the 1970s. During that crisis, the price of oil quadrupled in a year. Inflation in several developed countries broke the 20% barrier. Unemployment nearly doubled, and industrial production fell by more than 10%. However, we aren't seeing any of this today. It's true, gasoline is a bit more expensive, but inflation isn't skyrocketing and GDP continues to grow. Have we avoided the major crisis everyone feared? It's possible, but some analysts are talking about another possibility. What if we're living in the calm before the storm?
If the strait doesn't open by August, markets may find out the hard way. So says Rapidan Energy Group, which warned that the continued closure of the waterway through the summer raises the risk of a recession that may rival the global financial crisis.
2 months. That is the time frame Rapidan Energy gives for the Hormuz issue to escalate into a global crisis. So far, we've been able to hold out, partly because economies are much larger than they were in the 1970s, but in a sense, we also have vulnerabilities that didn't exist before. For example, companies no longer use large warehouses, everything is just in time. Supply chains are much more complex, and if one part fails, everything breaks down. So the question is, are they right in saying that a major crisis is just around the corner, perhaps as soon as August? Well, we'll see. Predicting crises is virtually impossible. And we've become accustomed to seeing a lot of analysts predicting crises every other day. Some have predicted 100 of the last 3 or 4 crises. In other words, if you constantly claim that a recession is right around the corner, sooner or later you're bound to be right. And that's why on Visualeconomik, we've investigated this topic in depth. And we can already tell you, there's a lot to unpack here. But first, if you're interested in the world of investing, if you want to learn how to manage your savings, protect yourself against inflation, and figure out how to make money beyond your day job, I've got some news for you. At Visual Factory, we've created the Visual Factory Club, a newsletter where every week we send out free content focused on essential financial education, the ABC of what everyone should know to understand the stock market, financial markets in general, investment platforms, how to assess investment opportunities, and which markets may have more or less potential. Because of course, if you want to invest your money so you're not at the mercy of your country's economic instability, you at least need to understand the basics of the financial world. In the Visual Factory Club, you'll learn all of this completely free of charge. Through the link below and this QR code, you can sign up for the club and start receiving the upcoming editions. What's more, when you sign up, you'll receive a dossier where I explain, in a clear and simple way, the most essential investment concepts, what multiples or the PE ratio are, what indices are, ETFs, derivatives, funds, EPS. You get the idea. After that, every week, you'll receive additional materials and market analysis to help you stay informed about what's going on. And by the way, the sooner you sign up, the better. Since we send each episode of the series by email and every edition is unique, if you're not subscribed, you might miss some of them and you won't be able to access them later. But with that said, let's get back into the video. Look, we have to start by acknowledging one thing. This time around, there are good reasons to believe that things aren't as good as they seem. You can't cut off 1/5 of the world's oil supply for months and expect nothing to go wrong, but I'll go further. The Hormuz crisis isn't just about energy. We've also lost the supply of nearly irreplaceable products like helium, the nitrates that power half the world's industry, and the fertilizers that contribute to feeding billions of people across the globe. The question is, are these sufficient cause to trigger a global crisis? The answer is yes. In fact, we don't have to look very far back in time. We have a recent example of another episode where an energy and food crisis triggered a global recession, the 2008 crisis. Because yes, I know that when we talk about the financial crisis, Lehman Brothers, subprime mortgages, financial derivatives, and all those things come to mind, but let's not forget that oil prices were also skyrocketing above $200, adjusted for inflation.
The United States was already more than 8 months into an energy-induced recession before the collapse of Lehman Brothers and the subsequent banking crisis.
In the summer of 2008, gasoline prices in the US exceeded $5.85 per gallon, the highest price in history. These days, we hardly remember this energy crisis, but it added an extra cost of about $2,000 a year for every household. What's more, Americans spent about $800 more on these bills than on their mortgages, and that figure was also at record record highs. According to one study, if oil prices hadn't risen so sharply, US GDP would have grown by an additional half a percentage point each quarter throughout 2009. In other words, during the crisis, the United States would have grown at a rate of 4% had it not been for the energy crisis. Now, it's worth clarifying something here. Despite everything going on in the Strait of Hormuz today, the price of a barrel of Brent crude is below $90, compared to over $200 20 years ago. How is this possible? Well, one explanation that is often repeated is that the market is too optimistic. Another is that countries like the United States are engaging in financial engineering to keep prices in check. However, futures prices do not seem to indicate that these explanations are correct. In reality, all of this points to another possibility: that oil is no longer as important as it was in 2008 or during the 1973 crisis. These days, we have solar panels, electric vehicles, and the industrial sector is a much smaller part of the economy. To this, we must add that while it's true that supply chains are more fragile, it's also true that the market is more dynamic in seeking alternatives. Take, for example, hydrocarbon exports from the US, Venezuela, Norway, or Brazil. In the absence of Arab crude, they have increased by 9 million barrels. Not all of this is production. Some of it is simply reserves. But even so, it's clear that refineries and oil wells around the world have stepped up their game. Meanwhile, demand is also adapting. And this is what explains why, for the moment, there hasn't been an economic crisis. Or at least, not for this reason. Because the problem here isn't oil itself, but rather that this crisis could trigger a recession in a much more subtle way. Pay attention.
The oil shock has mushroomed into a larger bond crisis. Borrowing costs have reached critical levels across the G7. They are resetting the price of credit for vast swaths of the global financial system. The effects are cascading through the mortgage industry and pushing a universe of over-indebted companies toward a refinancing crisis.
A rise in energy prices means one thing: inflation. And the numbers are starting to get a bit scary. The United States has gone from 2.4% inflation in February to 3.8% in April. That is nearly double the Fed's target. And what happens when inflation rises? Central banks start considering raising interest rates, and the financial system chokes. Well, the financial sector and the tech sector too. Thank goodness companies aren't making any massive bets on revolutionary technologies that could stop being profitable if interest rates rise too much, right? Well, jokes aside, that's exactly what's happening. In recent weeks, we've seen private equity firms like Blackstone, not BlackRock, Blackstone, prohibit their clients from withdrawing funds. The reason? AI threatens the business model of the companies these funds have invested in. But now, AI itself is also in danger, and from two directions. On the one hand, if electricity prices end up skyrocketing, data centers will pay dearly for it, both literally and figuratively. And on the other hand, if interest rates rise, the profitability of all these companies will plummet. Sounds bad, right? Well, wait, because it actually gets worse. What you're seeing on the screen are the unrealized losses of US banks. Banks hold assets like stocks or bonds that generate income for them. But if interest rates rise, the bank's bonds lose value. This is similar to what happened with Silicon Valley Bank, if you remember that. Since then, things have been improving, but banks still have unrealized losses totaling about $300 billion. If rates rise again, two things will happen. Losses will grow because their debt bonds will be worth even less, but profits will also fall, because these profits depend mainly on how the stock market performs, and the stock market practically depends on AI. And is it possible to avoid banking chaos if this finally happens? Well, a simple solution is not to raise interest rates, but is the Fed really going to let inflation skyrocket? It's complicated. The situation clearly doesn't look good at all. But it's not all bad news. There are also many reasons for hope. For now, the market doesn't believe inflation is here to stay. The spread between 10-year bonds and these same inflation-protected bonds is 2.3%, meaning that's the inflation the market expects over the coming months. After all, this figure is calculated by tracking the price changes of a fixed basket of goods. But when there's an energy shock, the market reacts, and the consumer basket can shift. And, as we've mentioned here before, inflation caused by excessive money printing is not the same as inflation caused by supply shocks like the closure of the Strait of Hormuz. On top of that, there's also also good news on the asset side. You all know that the US stock market has become addicted to tech stocks, and to artificial intelligence in particular. But since the end of the pandemic, and before AI became so trendy, productivity in the US was already growing at a rate above the average of the past 20 years. Remember, on this channel we've already seen that the US is going through a very unusual period, with record GDP and growth figures, but also with labour market data more typical of a recession than a boom. Even so, the economy as a whole is holding up, and more importantly, this isn't due to AI, but to improved productivity across all sectors. It's true that there are problems. Even without high interest rates, public debt in every country is becoming increasingly expensive because supply far outstrips demand, and this can also lead to financial problems. Now, we've saved the most important topic for last. No one has a crystal ball to predict when an economic crisis will strike. However, we do have a fairly close indicator: the yield curve gap. The yield curve spread is the difference between what long-term treasury bonds pay, for example in 10 years, and what shorter-term bonds pay, for example in 2 years. Normally, bonds pay more the longer you have to wait, but there are times when this trend reverses. And from the end of World War II through 2020, whenever this trend has reversed, a recession has followed between 6 and 25 months later, with a median of just 9 months. Today, by the way, the curve has its normal shape, and the Federal Reserve estimates that the probability of a recession based on the curve's evolution is only 13%. The yield curve's track record in predicting economic crises is impressive, but only in the United States.
In the United Kingdom, it produced false negatives in 1970, 1985, 1986, 1987, 1991, the entire period between 1997 and 2001, and depending on how strict we are, the year 2005.
This trick seems to work only in the US, and for good reason.
It would seem to be less a market prediction of recession than a correlation between the market's perception of slowing economic activity and the Fed's imperception or delayed perception of the same, and thus a tendency to err on the side of tightness at precisely the wrong moment.
The Federal Reserve has a long history of screwing up by raising interest rates at the worst possible time. For example, according to a book by Milton Friedman that has been widely acclaimed by economists on both the left and the right, this was the main reason why the Great Depression was so devastating. Fortunately, it seems the Fed is learning from its mistakes, and this time it does not appear likely to adopt a highly contractionary monetary policy. Conclusion: we shouldn't underestimate the closure of the Strait of Hormuz. Economic crises don't usually start with binges of financial speculation, but with shocks to the real economy. Fortunately, our economy is not as fragile as many people believe. In fact, recessions have been getting shorter, less frequent, and, above all, less intense for decades. Could a crisis occur in the coming months, as analysts like the ones we featured at the beginning of this video warn? Well, yes, in theory, of course it could, but I hope I've convinced you that if that happens, it will be unpredictable. In any case, now that we've gotten this far, it's your turn. Do you think we're on the brink of another major financial crisis? How long can the world hold out with the Strait of Hormuz closed? Will central banks learn from their mistakes in past crises? And if you really want to understand what's happening in markets and learn how to manage your money with more confidence, join the Visual Factory Club. It's completely free, and the link is in the description. And as always, don't forget that here on Visualeconomik, we release new videos every week, so subscribe to this channel, click the bell icon so you don't miss any of our updates. If you like the video, hit like, and I'll see you in the next one. All the best. Until next time.